Over the last 7 weeks, my inbox has been busy. Hundreds of messages. And they all have the same heartbeat underneath them. People are learning about term life insurance and then they hit that moment where they go, okay, but what about me? What about my timeline, my job, my family, my mess? Welcome to Wiseside Life and Legacy. I'm Na-kel Nikiema, and this is episode 8, our season 2 finale, listener Q&A, your term insurance questions answered. Today I picked 6 questions that kept showing up again and again. If you don't hear your exact situation, stay with me, because odds are one of these answers is going to snap your situation into focus. Season 2 has been a full deep dive on term life. What it is, how to pick a length, what the common add-ons mean, and what this looks like in real families with real responsibilities. Today is the practical episode. No theory for theory's sake. Just direct answers, in plain language, so you can make decisions with your eyes open. Alright, let's jump in. Question 1. A listener wrote, I'm 45, and I just realized I don't have life insurance at all. Is it even worth buying term now? Isn't it going to be way too expensive? Let me start with the part you might not expect. Yes, it's still worth it. Absolutely. In fact, this is one of those moments where realizing it late is still far better than realizing it later. Here's the way to think about it. Term life pricing is heavily tied to age and health. If you're a healthy 45-year-old, a 20-year term policy that covers you until 65 can still be surprisingly reasonable. For a lot of people, $500,000 of coverage lands somewhere around the neighborhood of a little over $100 a month, give or take, depending on underwriting and carrier pricing. Now zoom out and compare that to waiting. This is where the tension lives. Because at 50, that same coverage usually costs noticeably more. At 55, you can easily be looking at something like double what you would have paid at 45, especially if anything has changed medically. So when someone says, it's too expensive, what they often really mean is, I'm comparing it to what it would have cost me at 30. And yes, compared to 30, it's higher. But compared to 50 or 55, it's cheaper right now. So the real question isn't, is 45 too late? The real question is, do you have people who would feel the financial impact if you were gone? If you've got dependents, a spouse relying on your income, kids still at home, a mortgage, co-signed debt, or the kind of financial obligations that don't disappear when you do, then a 20-year term can cover what are usually the highest pressure years. Those years where people are still building, still paying, still parenting, still trying to catch their breath. And here's one more layer, even if you believe you won't need coverage beyond 65, many term policies include a conversion option. That means you may be able to convert some or all of that term policy into permanent insurance later without reproving your health. Think of it like buying flexibility. You're not committing to permanent right now. You're keeping the door unlocked in case life does what life does. So if you're 45 and uninsured, this isn't about feeling behind. This is about protecting your income while you can still qualify easily and while the pricing still makes sense. Your step is simple. Get a quote. Not a hypothetical. A real quote. Most people are genuinely surprised when they see the number. Okay, question 2. Someone said, I bought a 20-year term when I was 30. I'm 45 now, and I'm getting nervous that 20 years isn't going to be enough. Can I add more coverage now? Yes. You can. And that anxiety you're feeling is more common than you think, because life doesn't always line up with the neat little timeline we imagined at 30. You've got a few solid options here. Option 1 is the simplest, you can buy another term policy. You are allowed to have more than one. People do it all the time. This is what's called layering. Maybe you keep your original policy, and then you add a second policy that covers a different window of time or a different need. For example, maybe you want another 20-year term starting now, because you suddenly realize you want coverage out to 65. Or maybe you only need an extra 10 years because you're trying to cover your kids through college, or you're trying to bridge to retirement, or you have a specific debt that will be gone by then. But here's the trade-off: the new policy will be priced based on your age and health today. So yes, it will cost more than what you bought at 30. That's not a punishment. That's just how underwriting works. Option 2 is to get very specific about what you're actually afraid of. When you say, 20 years isn't enough, what are you picturing? Are you picturing being 50 and still having kids who need you? Are you picturing still having a mortgage? Are you picturing a spouse who would have to rebuild income alone? When you identify the actual obligation, you can buy the right amount for the right length, instead of just buying more years because of a vague fear. Option 3 depends on your current policy features. If you have a conversion rider, you may be able to convert part of your existing term into permanent insurance now, and keep the rest as term. That can be a powerful move for someone who wants some lifetime coverage without turning the whole plan into something expensive. Let me underline the big idea here: you're not trapped by the choice you made at 30. But timing still matters. The earlier you act, the more likely you are to get better pricing and fewer health complications in underwriting. If you're thinking about adding or extending coverage, don't sit on it for 5 more years and hope the math stays the same. Question 3. This one comes from a self-employed listener: my income swings a lot year to year. How do I figure out how much coverage I need if my income isn't stable? This is one of those questions that sounds complicated, but the solution can be pretty grounded. Start with a 3-year look back. Take your income from the last 3 years and average it. Not your best year, not your worst year. The average. That gives you a realistic planning number instead of an optimistic or pessimistic one. So if you made, say, $120,000 one year, $85,000 the next, and $110,000 the year after that, you don't anchor on the 120 and you don't punish yourself by anchoring on the 85. You average them. That gives you something closer to the income your household actually experiences over time. Then, because you're self-employed, I like adding a buffer. And I'm talking about a meaningful buffer. Roughly 20 to 25%. Why? Because self-employed income has different risk. Clients disappear. Contracts end. Expenses rise. A bad quarter can turn into a bad year. That extra percentage is there to protect against the volatility that doesn't show up neatly in a spreadsheet. Once you do that, you can plug the number into whatever framework you use for figuring out coverage. A lot of people use something like DIME, debt, income, mortgage, education, because it keeps you focused on real obligations instead of random rules of thumb. And one more practical point: if you're self-employed, don't treat your coverage needs as a one-time decision. Revisit it every 2 or 3 years. If your business grows, your responsibilities grow with it. And if your business shrinks, you might adjust too. You're allowed to update the plan. That's the whole point of planning. Question 4. Someone asked, if I leave my job, do I lose my life insurance? I'm worried my term policy is tied to my employer. Great thing to clear up, because this confusion costs people real coverage when they switch jobs. If you bought an individual term policy on your own, meaning it's in your name, you applied for it, you pay the premium, then no, it is not attached to your employer. It follows you. You could change jobs, quit, start a business, move across the country, and that policy stays in force as long as you keep paying it. You own it. What people are often thinking about is group life insurance, the kind that comes through work. That coverage is different. Group term is usually tied to employment. So yes, many times when you leave the job, that coverage ends or reduces. Now, there's an important detail: many employer group policies offer a conversion option. That means when you leave, you may have a short window, often around 30 days, to convert that group coverage into an individual policy without having to go through medical underwriting again. That can be extremely valuable if your health has changed. But I want to say this plainly: don't build your entire life insurance plan on work coverage. Treat group life as a bonus, not the foundation. The foundation is your own individual policy that you control. If your employer offers group term, take it, especially if it's cheap or free. But make sure your primary protection isn't something you lose the moment your job changes. Question 5. This one is about return of premium term insurance, or ROP. A listener said, "I've heard return of premium can actually make sense sometimes. Is there any situation where I should buy it?" So, here's the baseline. In most scenarios, plain level term plus investing the difference is the better financial math. That's why I usually lean that direction. But you didn't ask me what's most common. You asked me when it could make sense. And yes, there are a few edge cases where I can see it being a reasonable choice. First edge case, you know yourself, and you know you're going to feel constant regret if the term ends and you got nothing back. Some people can't stand the idea of paying for something they might never use, even though that's literally the point of insurance. If that mental friction makes you more likely to cancel early or never buy coverage at all, then paying extra for ROP might be worth it for peace of mind. You're not buying a better return, you're buying less second-guessing. Second edge case, you're not going to invest the difference. Let's be honest. Some people here invest the difference, and what actually happens is spend the difference. If you're confident that the extra money won't get invested, then ROP becomes a kind of forced structure. At least you know the premiums are tracked and returned if you outlive the term, assuming you keep the policy to the end. Third edge case, behavioral commitment. Some people do better when the savings is built into the system and they can't easily mess with it. ROP can function like a commitment device. It's not the most efficient vehicle, but it can be effective if it's the only way you'll stick with the plan. So my honest answer stays the same. For most disciplined people, level term and investing separately is the cleaner move. But if you fall into one of those specific behavioral situations, ROP can be a defensible choice. Not magic. Not universally better. Just a fit for a certain type of person. Question 6, and this is the one that really sets up what we're doing next season. A listener asked, when should I buy permanent insurance instead of term? What's the trigger where you say, okay, now it's time for permanent? This is the right question to end season 2 on, because term is often the right answer for the working years. It's straightforward, it's affordable, and it covers the high responsibility window of life. But permanent insurance enters the picture when something changes. When the need isn't temporary anymore. Trigger number 1, you're reaching the end of your term and you still need coverage. Maybe you planned to be financially independent by then and it didn't happen. Maybe you're retiring later than you thought. Maybe you still have someone depending on you. Or maybe your health has changed enough that buying a new term policy is either very expensive or not available. In that situation, permanent coverage can be a solution, sometimes through conversion options, sometimes through new underwriting, depending on the case. Trigger number 2, you want coverage for your entire life, not just a fixed window. Some people want a death benefit no matter when they die, because they're thinking about legacy, final expenses, providing for a lifelong dependent, or leaving a gift to a charity or community. That's a different goal than income replacement for 20 years. Trigger number 3, you specifically want cash value. Permanent policies can build cash value that, in certain designs, can be accessed through loans or used as part of a broader financial strategy. That's not a reason for everyone, and it needs to be evaluated carefully, but for some people it's a real objective, not a marketing bullet point. Trigger number 4, wealth transfer and tax strategy. If someone has significant assets and they're trying to move money efficiently to heirs or cover estate taxes, permanent life insurance can become a tool in that conversation. That's usually a high net worth planning situation, and the details matter a lot. So if you're listening and thinking, does that mean I should buy permanent? For most working families with kids, a mortgage, and a need to protect income, term is still the starting point. Permanent isn't the default. The goal is matching the tool to the job. And next season, we're going to unpack the permanent side, whole life, universal life, variable universal life, without the hype and without the fear tactics. And that brings us to the close of Season 2. Here's what I want you to do before we move on. First, if you don't have term insurance and you know someone depends on your income, go get a quote. Make it real. Numbers change the way you think. Second, if you already have a term policy, pull it up and look at the expiration date. Don't just assume you remember. Actually look. And then do something simple, set a reminder about 2 years before it ends. 2 years gives you time to shop, reassess, and make choices without panic. Third, if you're thinking about adding coverage or adjusting your plan, consider talking to an independent broker, not someone who only represents one company. You want options. You want comparisons. You want someone who can look across carriers and designs and help you match coverage to your goals. Season 3 starts next week, and we're going straight into permanent life insurance. What it actually is. When it makes sense. When it doesn't. The trade-offs compared to term, and the mistakes people make when they buy it for the wrong reasons. I'm Na-kel Nikiema, and this has been Wiseside Life and Legacy. Educate. Empower. Protect your legacy. I'll see you next week.